Welcome to today's explainer for August 24th, 2026. Right now, if you're looking at global markets, you're seeing them caught in a massive multi-front squeeze. We're talking escalating trade disputes, brand new geopolitical sanctions, and a reality check in the IT sector that everyone has been holding their breath for. There's just so much friction out there right now. So we're going to break down exactly how all these global ripples are colliding and look at the latest data to try and make sense of all this noise. Let's dive right in.
So what's the high-stakes backdrop to all this market friction? $40 trillion. Yeah, you heard that right. That is exactly where the U.S. national debt currently stands. To put that completely massive scale into perspective for a second, if you spent $1 million every single day, it would literally take you over 100,000 years to blow through $40 trillion. It's astronomical. And as investors are looking at global markets today, they are heavily scrutinizing this enormous level of federal borrowing. It basically sets this super tense stage for all the economic anxieties we're seeing ripple through the rest of the market.
And this debt anxiety is bleeding straight into our first major ripple, which is trade. The American-Canadian auto agreement, which was supposed to keep duties on Canadian cars at a manageable 15%, has completely collapsed. In its place, President Trump has threatened a whopping 50% tariff on Canadian cars, trucks, and parts starting January 1st. But Canada? Well, they aren't just waiting around. They're actually planning dollar-for-dollar retaliatory tariffs on selected American products kicking off on September 8th. For manufacturers, workers, and everyday consumers on both sides of the border, this tit-for-tat escalation means sudden, severe supply chain disruptions. We're talking surging costs right around the corner.
Okay, so the friction doesn't stop there. It extends right into the Middle East. Treasury Secretary Scott Bessent just launched a really sweeping sanctions campaign against Iran. They are targeting over 60 individuals, organizations, and vessels to basically choke off revenue. The goal here is to block access to the whole shebang, everything from shipping and aviation all the way to gold and digital assets. Washington is even threatening secondary sanctions against governments that maintain commercial ties with Tehran. Though it is worth noting that major Chinese financial institutions have avoided immediate penalties, likely to preserve some room for diplomacy.
Now, the geopolitical ripple effect from all this, it is immediate. Tehran is explicitly threatening ships in the Strait of Hormuz, promising retaliation against absolutely anyone who cooperates with this U.S. financial campaign. They've even published a list of vessels they consider non-compliant and threatened to halt all Gulf oil exports if the economic pressure keeps up. So as you can imagine, global energy markets are completely exposed right now to this very specific shipping risk.
So how does all this geopolitical stress and trade friction actually manifest on Wall Street? Well, it creates some deep anxiety, especially right ahead of critical tech earnings. Semiconductor shares took a really sharp dive recently as investors scramble to reduce their exposure ahead of NVIDIA's highly anticipated earnings report. Just looking at the numbers, Micron is down nearly 5.6%, NVIDIA dropped 2.3%, and Broadcom fell 2.1%. And look, analysts are expecting NVIDIA to report a staggering $92 billion in quarterly revenue. But even with expectations that high, given all these macro pressures, the market is clearly very anxious.
So why are those expectations so impossibly high? Well, it's not just the federal debt we have to watch, it's corporate debt too. $220 billion. That is the amount of debt American tech companies have issued in 2026 alone, just to finance their artificial intelligence expansions. The newest AI processors carry massive premium price tags, and this huge wall of corporate borrowing is putting incredible pressure on these companies. Basically, these investments absolutely have to pay off.
And that brings us to the AI reality check. Corporate buyers are now demanding real, measurable financial ROI before they approve even a dime more for infrastructure spending. Meanwhile, essential safety guardrails are finally starting to catch up to the technology itself. For instance, OpenAI just launched ChatGPT for teens with specific age-appropriate safeguards. Congress is actually considering mandatory independent AI security audits following some recent testing containment failures. And Meta, they're actively testing algorithms to ensure vital child safety protections. So all this massive capital spending is crashing headfirst into these absolutely necessary safety and regulatory demands.
And honestly, this is the core tension defining the markets today. Investors are trapped in this high-wire balancing act. On one side, you have resilient tech earnings and this incredible AI innovation. But on the other side, they are fighting against a compounding wall of friction. Iranian sanctions, Canadian auto tariffs, record government debt, and let's not forget persistent inflation risks. It's a lot to juggle.
Which leaves us with one really critical question. Can the sheer productivity of this AI boom actually outpace the heavy friction of escalating global trade wars? As we await Wednesday's inflation data and the big Jackson Hole meeting,
That is exactly what the market is trying to price in right now. It's definitely going to be an interesting few days. Thanks so much for joining me for today's explainer. Keep learning, stay curious, and I'll see you next time.